Sadly not true. Let's break down that, shall we? Now, I've made some notes here for you and gone into detail both into the legislation and the multiple ways in which the kickbacks actually still go on. So the first way, the bit you're probably referring to, are the legacy commission structures, pre-RDR. Fair enough. Before the retail distribution review, which was back in 2013, it was common practice for product providers like St James's Place to pay commissions directly to IFAs. So you might think, well, of course, that's got rid of it. These commissions, by the way, were often in the range of 3 to 5% of the investment value as an initial charge, and then ongoing or trail commissions, usually about 0.5% per annum. Now, obviously, that created a conflict of interest, so the RDR was implemented. You'd think that would make things better. Sadly, unintended consequences. Post the RDR, yes, rules changed, made things worse. First of all, whilst IFAs cannot receive commission from fund managers for new retail investment business, they must charge clients, of course, a transparent fee agreed in advance. In theory, this means no more kickbacks. In practice, the money still flows, it's just more hidden, which is what you would have expected if you were shrewd when it comes to understanding how legislation works. And as a lawyer, I can tell you, close one door, loads of others underground happen. So let's see how this happened. It happened through two main ways. One, restricted advisors, and secondly, vertically integrated models. So let's take St James's Place, shall we? SJP doesn't rely on these independent IFAs. Instead, it uses a captive network of partners who are restricted advisors. What does that mean? They're not independent. Absolutely. They're only able to recommend SJP's own in-house funds and products. So whilst many people might use the I in IFA, Independent Financial Advisor, and still refer to SJP's people as IFAs, it's worse than being independent. They're actually restricted, can only offer their products. That means when you invest via an SJP advisor or partner, you're investing in a narrow group of funds, SJP's funds, which are often white-labeled versions of third-party funds with an extra layer of fees added on. The advisor, the partner, gets paid a commission by SJP. A commission by SJP. Not by you, of course, by SJP. Up to, let's say, around 4.5% upfront and 0.5% to 1% annually. Sound familiar? A bit like the old structure.